What is up, everyone, and welcome to another episode of Personal Finance Boss. So, my name's Julian, Ali is with me, and today our topic are ETFs. And ETFs are my favorite investment vehicle at the moment. Maybe, a couple of years it'll change, but for now, they're my favorite investment vehicle. So, why is that so, Ali?
So ETFs or exchange traded funds.
Yeah.
They're great in so many ways. They offer the diversity of mutual funds. They offer the index returns if you'd like. They offer cheap fees. They're traded on an exchange. What I mean traded on an exchange, they're either traded on the big markets like the Dow Jones or the Toronto Stock Exchange. You can see the value changing.
I don't think they're on the Dow Jones though, because the Dow is the top 50 companies, right?
No, I mean they're
They're
traded
on the
New York Stock
Yeah,
Exchange.
New York Stock Exchange or the
So
Nasdaq.
yeah, on the exchange,
Yeah,
but it's
yeah,
just the Dow
yeah.
Jones. We're just
You could get a Dow fund.
yeah. You could get a Dow fund. So
yeah.
they're traded on the exchange. Thank you, Julian. So they're traded on the New York Stock Exchange or the Toronto Stock Exchange.
Yeah.
But they're traded on big markets, even in I think in Europe as well. They're traded on
Yeah,
probably
yeah,
the FTSE,
for sure,
the FTSE in England.
sure.
But
all around the world.
anyway, like mutual funds are priced at the end of the trading day. ETFs, their price changes throughout the day.
Yeah, so what that
Just
means
like
is
a
that
stock.
if you wanted to buy a stock at 9:30 a.m., if Eastern time, if you're trading in the States, and you wanted to sell it at 10, you could. And if the stock or if the ETF or whatever would have moved 1% within that 30 minutes, you can benefit from that 1%. But for a mutual fund, if let's say you're on Monday at 12 or 1 p.m. you want to buy it, your transaction is only going to go through the following business day.
Mm-hmm.
So if you know that the stock market's going to go up 10% in the next 3 hours from 1 to 4 p.m. and you wanted to take advantage of that jump, you couldn't do it in a mutual fund because the transaction would go through the next day. Yeah. Same thing if the market tanks and you want to get out, even if you sell at 9 a.m., 9:30, whatever, when the market's open, your transaction is only going to go through the following days or at 4 when the market closes, right?
Yeah.
So you're kind of out of luck for that.
Mm-hmm. And even if you were able to capture the mutual fund, it takes like 3 business days for it to settle. Yeah. Then you get the money, and then 3 business days to make another move. So a week, by that time, a week's gone. Yeah. And we all know what can happen in a week.
Yeah, it's much more clunky. So ETFs are like the lean mutual fund.
The lean machine.
Yeah, that costs a lot less money. So just as an example, we pulled up a couple names. Vanguard is particularly popular when it comes to low-cost ETFs. So the Vanguard S&P 500 ETF, meaning it's an ETF that tracks the S&P 500. And the S&P 500 is an index of the top 500 companies in the States. Yeah. So, and like 502, 503, and they always switch. The bottom ones go out, and then the 503, 504, 505 come into the index. So I don't know how often they change it.
Rebalance
every year, I guess.
Maybe every year, based on how the market is doing, based on how the company's performance.
Yeah, if there's reason to doubt that that there needs to be a change, then probably they'd rebalance it at that point. But I'm not sure what the frequency is. So this expense ratio is 0.05%, right? Yeah. And just as a comparison, if you were to buy index ETF, that tracks the same thing. Depending on what financial institution you'd be going for, it could cost you anywhere from 0.4% to 1%. So it's minimum of 8 times and maximum of 20 times more expensive. So how does the fee work exactly? How does the MER work?
So the way the MER works, so let's say the fund,
and the MER stands for what again?
The MER is the management expense ratio. Basically, the fees to run that investment. So that covers the fee for the salary for the advisor who's managing the money.
Portfolio manager.
If he's
the advisor that at the bank that sells you the fund.
Exactly. Also, so it covers the advisor fees. It covers the transaction fees because there is transactions to buy those stocks initially. And various operational costs that are issued to maintain the framework, to maintain the trading work, the accounting and everything. Yeah. But anyway, if you're looking at a fee of 0.05%, that's still tremendous. And the way the fees work is, let's say the fund for the year returned 5%, the fee is included in that 5%.
Yeah, meaning that if you go and you look at the PDF sheet, the fund performance over the year, so year to date, last year, last 3 years, last 5 years, the fee is already deducted off of the percent return that you see, which I didn't know. Ali told me that.
So if the fund returns, so for example, for this Vanguard S&P 500 ETF, if they returned 5% last year and the fee was 0.05%, the actual return of the fund was 5.05%.
Yeah.
So the difference between your return and the actual return of the fund is so little that
for an ETF, for
an
low-cost
ETF,
ETF,
that it makes it such a versatile tool to use. And for example, like Julian said, the mutual funds, if you took an index mutual fund, for example, like I know at TD, they have a E-Series fund, which are reduced mutual funds. Their MER for about the same fund would be 0.3%. If I went with another...
Which are still cheap compared to other funds that, you know... The easiest funds you get to. So if you go into a retail bank and you say, I want to buy index fund, what they're going to sell you will be at minimum 0.4%.
No, that's only TDE series.
Okay.
If you went like the basic, like if I went to a Scotia bank, I want an index fund right now, index mutual fund, probably around 1%.
Okay, yeah. I mean, but these are things that you guys can check on your own. And, you know, like every bank will have their own thing, and then you don't even have to go to a bank. You can go to an investment firm, and then they have different pricing, right? So the point of it isn't to say, oh, this bank is better than that bank, because, you know, they're all the same. There's 5 or 6 big banks in Canada, and they all offer the same service, you know?
So why are we talking so much about fees? Like, if the return is giving me 5%, regardless of the investment, shouldn't I take it regardless of the fees?
Well, we touched this in the mutual fund podcast a lot, but if, you know, with the rule of 72, which we talked about in the compound interest podcast, which is if you make 10%, you take the 10% return and you take 72, divide it by your return, so divided by 10, it gives you 7.2. Oh, that was so clumsy. Anyway, so every 7.2 years, your money doubles. So if you take off 2%, right, instead of getting a 10% return, you then get an 8% return. And I will not do the math, but it is longer. So it's about
9 years.
It's like 9 years.
72 over 8 is 9.
Exactly 9 years.
Yeah. And if we take like a high MER on a mutual fund, I think the highest I've seen is maybe 3%.
Yeah.
Now we're doing 72 over 7. So now we're looking at a close to 10 years.
Yeah.
Just for a difference of what, 2 to 3%.
Yeah.
Which for some seems so minimal, $100.
Yeah, but if you think about it, let's say you have $1,000 that doubles and doubles and doubles and doubles and doubles. If your money can double two extra times, right?
Yep.
Like, it's not 2,000 times 2. No, it's going to be the doubling of the doubling of the doubling. So you'll have 40,000, and then that 40,000 will get to double 2 more times, which means 80,000.
160,000.
And then which means 160,000. Yeah. So the 2 extra percent can cost you a huge amount of money, right? And that's why I'm a fan of the ETF. Because if you don't follow the stock market like really, really closely, and you don't focus in on a sector, because there's no such thing as a guy that could invest in all the stock markets and all the sectors and say he knows what he's doing. If you meet a guy that does that, he's probably has no idea what he's doing, right? Yeah. So if you don't follow the market, if you don't follow a sector like oil or healthcare or pharmaceuticals or commodities, right? The best thing that you can do is say, I don't know what's happening. I'm closing my eyes and I'm buying the market, right? But if you had to do that without the existence of a mutual fund or an ETF...
Or buying all the stocks.
No, you would literally need to buy all the stocks on the market, and that will cost you a fortune because every time you do a transaction on like an online brokerage account or not, there's a commission. $5, $10, $8, depending on who you go with. So... if there's 500 stocks in the S&P 500 index, it's 500 stocks times $5 commission, which is the cheapest that I've heard of in Canada, right? So that's $2,500.
Yep.
So,
and the problem that arises as well, since there's 500 stocks on the S&P 500, and each stock is different, it costs a different amount. Even if I wanted to buy each one, I would need so much money to buy all of them.
Because every stock is weighted differently. So if you look at a company like Apple, which is huge.
Or Amazon, that stock is $800. It's almost over $1,000 Canadian.
And then you look at some smaller company in the S&P, like
3M or something.
Yeah,
that's
whatever.
like $80 or something.
Well, it's not. It's just like also the market cap, because the index is weighted according to the market cap, which is, by the way, if you take the amount of shares outstanding. So let's say Google has 3 million shares. No, 1 million. Easy math. 1 million shares outstanding, right? And every share is worth $700. Their market cap is 1 million times $700, which is 700 million. Pretty sure it's that. So that means Google's market cap, or was it Apple? Whatever company I said, Google. Google's market cap is $700 million. And then if you say 3M has...
Probably a lot less.
Yeah, let's say their stock is worth $10 and they have 1,000 shares outstanding, then their market cap is 10,000, which isn't the case, but let's just say too extreme. So you can't say, okay, 50% Google and 50% 3M, and then I own the markets in the proper proportions, because Google is a much bigger company. So 99% would be Google, and then 1% would be 3M. But then you'd have to sit down with the calculator and literally say, okay, I'm going to invest $3 million in 500 stocks, and you'd have to crunch out the numbers and see how many stocks of each company you'd buy according to the weight, which take forever. And to avoid that, all you need to do is pay 0.05% of your total investment. So if you invest $1,000, then you'd be paying 50 cents.
Yeah.
50 cents, great. It's 50 cents
Yeah.
per year for them to manage it. But then if let's say after the first year you have 1,000, then becomes 1,100 because you made money during the year, stocks went up.
Yep.
Then you'd be paying 0.05% of that.
Yeah.
So that's how the expenses work.
And I think another thing with mutual funds, and this research has another thing with ETFs, and this research has really come out, is that even the best advisors that sit there at the screen saying, "Okay, buy this stock, buy that stock."
Advisor is portfolio manager.
Yeah.
Yeah.
And then even with their selected stocks, they're either matching the benchmark, so matching the return that the TSX or Dow Jones did in a year, or just barely beating it.
Yeah.
And by barely, I mean
that's over like a period of 5 years, right?
Yeah.
Because if you take a mutual fund and you take like the benchmark is, if you are a healthcare mutual fund, you will compare yourself to the healthcare index. You're not going to compare yourself to the commodities index because it's not the same thing.
No.
So that's what he means by benchmark, right?
Yeah.
So.
But anyway, this research has come out that
a long time ago. This isn't new.
No,
this
but
it's
surfacing now that ETFs are coming on the market. It's surfacing that why buy ETFs, because they're a fairly new product compared to mutual funds.
Of course, yeah.
Fairly new. So people are saying, why should I trust this product? And it's because they're able to generate very similar returns at a quarter of the cost compared to
at least a quarter.
Yeah, at least a quarter of the cost that a selected advisor who has years and years of knowledge is doing, picking selected stocks.
Yeah, portfolio manager.
Exactly, a portfolio manager. So that's another reason why ETFs are so great.
But that's a whole debate, like between actively managed funds. So if you have a portfolio manager sitting down and whatever with a whole team looking to pick stocks, so you have a specialist in this sector, specialist in that sector, and they're saying, okay, buy this, sell this, and trying to actively generate alpha. That's the term that they call the excess return above what the average benchmark makes, right? So they're trying to go after alpha. You could say that to your friends, you'd probably sound cool. And then there's the more passively managed mutual funds or ETFs, where it's just a team that says, okay, this is how we are going to allocate, choose the weights. They're just choosing the weights for you, and they have a fund, and then that's it. And they don't touch it. So the debate is it really worth paying extra because it costs money if you have a portfolio manager picking stocks actively versus just picking weights and then rebalancing depending on how much the market cap of the different companies changes. And so over 5-year periods or 10-year periods, 95% of the funds underperform the benchmark. However, 5% do overperform. But those portfolio managers that do overperform over long periods of time usually lock in, you need a minimum of a lot of money to invest.
Yeah.
I don't remember.
Million probably.
Oh,
million minimum.
Minimum. I'm talking about maybe 50 mil or something like that, where you need to have the rich get richer type of thing to benefit from that. So ETFs are really a way for the regular person to invest in the market. So how would you go about buying an ETF?
Getting through the broker and everything.
Yeah.
I'd open a brokerage account.
Yeah.
So good brokers that I deal with Questrade. They're an online broker. To buy ETFs are free with them also, so that's an added incentive. If you don't feel comfortable going the online route, you can go through your bank as well.
Yeah, we're not paid by Questrade, by the way. This is who we use because the fees are pretty low.
Mm-hmm.
In terms of like full service, we don't do complicated transactions, so we don't short sell or anything like that yet. Probably get into that at some point.
Mm-hmm. But yeah, Questrade is a great place you can go. ETFs are free to buy. Buy it once, and you didn't have to pay anything, and then you just pay when you want to sell. If you ever sell, you pay your $5 and you get it out.
$10.
$10?
Yeah,
it's $5.
No, it's $5 to buy, $5 to sell, but they don't charge you on the buy, so they charge you 10 on the sell. Yeah, no, I checked the statements. Okay. So the way it worked, but I mean, it's great that they don't charge you to buy, because if you wanted to like save $100 every week, like buy a share of whatever ETF, they're not going to charge you $5 every time, which would cost you so much money. So it's a great way to like dollar cost average, which is another great topic for a podcast, which we'll get to in the future.
And just because you're investing in an ETF as well, that doesn't mean you're going to miss out on the dividends that companies pay out as well. The ETFs pay out the dividends in a form of distribution, depending on the fund. They'll pay it out either on a monthly or annualized basis, but you're still going to get your dividends. So if that's one of the reasons that's swaying you towards getting individual stocks, there's nothing to worry about because you're still going to get them.
Yeah, so if you invest in like a blue chip type ETF that has big companies, established companies that pay dividend, unlike Google, but if you have like Boeing, or we're talking about Bell Canada, how they have a 5% dividend, which is pretty crazy. So if you own ETFs that have companies like that, you will be receiving the dividends. So it's you're not like they're not stealing those from you.
And we talked a lot about index ETFs, but ETFs are offered in so many different fields too. There's a healthcare ETF.
Yeah, but they index all the different.
But like you could pick an ETF that's like that's tech based only and picks like has a weighting towards certain companies or even international based as well.
Yeah, like if let's say your parents work in the healthcare field and you're like, oh man, we're getting more and more contracts. We're doing great, but you don't want to invest in their company specifically because there's added risk when you invest in one company versus all. So like, you know what? I think I want to invest in the healthcare sector, broadly. But how do you do that? Do you buy the 3 biggest pharmaceuticals, or what do you just buy a healthcare ETF? It's really simple.
Yep.
And there's many companies that create these baskets. So there's BlackRock, there's iShares.
There's Vanguard.
Or does BlackRock own iShares? No. Yeah.
There's BlackRock, there's iShares, there's Vanguard. BMO has their own. BMO has a huge
lot
selection
of
ETFs as well.
ETFs.
And what's great also I found about ETF is sometimes you come across an investment like me recently a while back. I wanted to invest in Africa, and I was like, okay, how do I find a company that's in Africa and I want to invest on it? I have to go through. Someone told me like you have to go through the Johannesburg exchange. You need to create an account there. You need to go there, fly there. I'm like, I don't got the time for it. And then Julian's
or the
like,
money there, to buy some company.
And Julian's like, dude, there's an ETF for it. Just look it up. And I found an ETF. So
I think I remember that.
The best part of ETFs, whatever you can think about, whatever crazy investment you can think about, just Google it, and you're most likely gonna find an ETF that covers it too.
Type in African ETFs or South African, like in whatever country in Africa you want.
And you're most likely gonna find one. Even for Asia too, you're gonna find them.
Of course, Asia for sure.
So they're really broad. They're essentially covering every base that you could think of in terms of crazy investment ideas that you think are gonna soar in the next few years.
Yeah. So what's your overall approach to buying ETFs? Like, what do you own ETFs?
I do. I have a few.
Okay, like what?
A few. I have the Africa one.
Okay.
That we talked about.
How's that been performing?
The Africa one I bought a while back. I think I have.
That means if he stalls, it's because it's not doing very well.
No, I bought it. I bought it in my competition for my charity competition. Okay. I think I started that 2 weeks ago. I think I won 2%, 2.5% in that.
Okay. Oh, so you've only had it for 2 weeks?
Yeah, I've only had it for 2 weeks. Okay. And then I had a BMO one for a while that I think in the last year
maybe. Is it the ZDV one?
Yeah, I think that was about 8%. In the last year, 10%.
Yeah, it tracks the TSX,
which
was Toronto Stock Exchange,
which was a pretty good one. And then I had another ETF that tracked corporate debentures, which are company bonds, that I think was 6% for the year.
6% on company, that's pretty good.
Yeah, company bonds. So those were some really good ones. What about you?
Yeah, well, I'm starting to try out portfolio theory, right? Because being a student, we're both students, and we both have jobs, and we both do extra stuff like the podcast. Our time is limited, so we don't have tons and tons of time to research stocks. So I'm trying something called portfolio theory or whatever, where you invest based on diversification. So like let's say I don't know what my weights are exactly, but I invest in the S&P 500. So that gives me exposure to the American stock market or the American economy, the top 500 companies. And then I invest a little bit in emerging markets. Although some people say investing in the States is investing globally since the States does business globally, but investing solely in emerging markets is a bit more volatile because they're a bit more crazy. But emerging markets, like Brazil, a lot of the South American countries, a lot of Asia probably considered emerging. Africa, not so much considered like emerging markets.
Emerging markets.
Yeah, it's like pre-emerging markets. But no, there's the more pre-emerging they are, the more money you can make.
Yeah.
But more risk, more return. And because there's a lot of problems with laws, right? With
there's laws, there's foreign exchange, there's legislations. Another thing that's really hard to track with them is since they're in different time zones as well, for you to personally track them makes it difficult. So that's why you buy the ETF for them.
Yeah.
So there's
what I'm saying is that there's a lot more like in the States, people think or say that the market is efficient or very efficient or pretty efficient, right? Meaning that there's no this might be a bit common, but there's no free money to be made because all the companies are priced accordingly based on all the information that we have. So as soon as like earnings come out or like we did great this quarter, we did really bad, the price immediately reflects the news, right? But when you go into emerging markets and you go to third world countries where not only may the flow of information be slower, but the laws preventing, let's say, Microsoft to run the world by the only computer in the, only operating system in the world, and not have Apple as a competition, exists.
Like the stock market in China, it's a good example.
Yeah, or like even Brazil, because I did a lot of research with Brazil, but there are companies that have like 75% market share, and with all the trade restrictions, foreign companies cannot export to Brazil, so they have an advantage. So when you invest in companies like that have like a economic moat, which is it's like they're in a fortress, then it's hard for them to erode their profits, so their margins stay high over long periods of time. Long story short, emerging markets are interesting when it comes to investing in an ETF because you get exposed to these anomalies, let's say, that allow you to make more money. And then I also have a real estate ETF, a REIT, a REIT, yeah.
Another good topic.
Yeah. I don't know much about that.
REITs are great.
Yeah, a lot of nice dividends. And then I have a Canadian, the ZDV tracks the TSX plus dividends. And that's pretty much it. But I buy ETFs every maybe $500 every month, or depending on how prosperous my months are, I invest more or less. But since it's free to buy, I don't mind doing it. So I think like we pretty much touched why like ETFs are baller. They're a baller investment. Like they're my favorite thing because for the average person who doesn't know what it is they're doing but they want to invest, it's better you go and open your own brokerage account and buy ETFs than go to a bank and buy a mutual fund just because of the fees. Right? And the people that sell you, not like the financial planners, but the financial advisors that sell you the funds, don't necessarily know as much as you think they know.
And they may not always have your best interest in mind.
Exactly.
As well.
There is, we can talk about that too.
That's another
great episode.
Another great
bashing commercial banks.
Bashing commercial banking. I have a lot of experience in that.
Yeah.
But anyway, that's it for us, guys. I hope you enjoyed. As always, you can contact us at personalfinanceboss@gmail.com.
We have an email now. You can also leave comments on the podcasts.
On SoundCloud or on iTunes. You can find us there. And then you can also visit us at personalfinanceboss.com.
Website in progress.
Website in progress. But email us with questions, comments, tips, whatever you like.
Or hate messages, or trolling. That's you're probably gonna get that once we get more listeners for sure.
All right, guys. Have a great night.